Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. You can join Brian Curtis and myself for the stories making news and moving markets in the APAC region. You can subscribe to the show anywhere you get your podcast and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. Let's take a closer look at this Nvidia story and the sell-off in the chip sector. Dan Ives is with us. He's managing director, also senior equity analyst at Wedbush Securities. So it looks as though we've got concern on the part of antitrust regulators, Dan, that Nvidia may be, I don't want to say an abusive monopolist, but certainly infringing on perhaps anti-competitive practices. What do you think?
Yeah, look, I mean, this is the theme that we've seen across big tech, right? I mean, from Google to Apple to Amazon, of course, now Nvidia. Look, they're the only game in town, but it's really because of innovation while they're the only game in town. So I think this is one, probably, the headline's scarier than probably the reality in the near term. But no doubt, this was not the right day for this to come out, given the white knuckles we saw across chips.
Yeah, you're in Seoul today, which is kind of curious. And some of those high bandwidth memory chip manufacturers are in South Korea. And I'm thinking SK Hynix, I'm thinking Samsung. From your perspective, being there, what is the degree of the knock-on effect? Is it great? Is there a pretty strong correlation between what happens in Nvidia stock and what happens with a company like, say, SK Hynix?
Look, I think it's a huge correlation. And that's why what we're seeing here for semis is a once in a 30, 40-year type of cycle. But that's not stopping. In other words, we're going to have these periods of sell-off, just like we saw Tokyo Black Monday and like we saw today. But if you look at the demand's outstripping supply 15-1. So that continues to be a huge tailwind for all of these chip players.
What are you hearing on the ground there in South Korea? I'm curious just about what's going on in the U.S. and particularly in regard to AI.
Look, I think there's a big focus, not just from investors, but from the actual, from the tech players in terms of seeing where this demand curve is going to go. I think there's a lot of optimism that we are still in the early innings of where this is going. I think the big question is, okay, Nvidia, everyone understands. Now, who are the next players to benefit? And I think that's really going to be the focus, not just here in Korea, what we see across Asia, and really what we see across the globe. Because, look, Nvidia is the start, but it's a huge multiplier. For every dollar spent on a video chip, we think there's an $8 to $10 multiplier. That would be a clear benefit, especially some of the players here in South Korea.
But when you consider a company like Advanced Micro Devices, which is trying to do what Nvidia does with these graphics processors, what is the runway that AMD needs to even become competitive with Nvidia?
Yeah, look, betting against Lisa Su and AMD, I think that's the wrong bet. I think they will be major players in this race. Now, look, Nvidia's years ahead. But if you look, this is going to be $1 trillion of incremental AI CapEx. So if AMD gets 5-10% of share, I don't believe that that's baked into the stock. And I think that's really the focus now. It's who are the other beneficiaries, second, third, fourth derivative, because it's clearly something that's playing out. And I think we saw with Nvidia earnings last week. It's undeniable in terms of what this trend is. But you'll see sell-offs like today. You'll see sell-offs like we did a few weeks ago. I still believe tech goes to all-time highs, over the next 3 to 6 months.
Dan, when I think of NVIDIA, I think of TSMC, the big foundry in Taipei. Is there a conversation where you are now in South Korea around diversifying the chip supply chain, maybe, and allocating a little bit more on the foundry side in South Korea?
Yeah, look, I think theoretical, but for right now, TSMC has hearts and lungs. And I think this is something that's really going to be playing out over the next 12, 18, 24 months. In terms of the supply chain, it's just going to continue to expand. Part of it is not just about TSMC. It's just demand is so strong relative to supply. There's going to be a lot of players that benefit that today I don't believe are on the radar especially from a global perspective of investors.
Dan, it's always a pleasure. Thanks for making time to chat with us. Dan Ives is the managing director. He's also senior equity analyst at Wedbush Securities. Adam Coons, the co-CIO at Winthrop Capital Management, joining us from the heartland of Indianapolis, Indiana. Thanks for making time for us, Adam. Let's talk about this ISM data. I think that really, in large part, helped to put the market on the back foot. Wouldn't you agree today?
First off, thanks for having me. And yeah, I do totally agree. ISM is one of those indicators that it does have a lot of correlation to, where the economy is heading. You look at employment and things like that, those tend to be quite lagging indicators. But this continued deterioration in ISM does give me more caution about, kind of where the economy is heading.
One of the things I think the market seems to be indicating here is that the rate cut that we're expecting in a couple of weeks, less than 2 weeks' time, will be 25 basis points. But we do have a lot of data to consider on the labor market this week. It culminates, obviously, with the employment report on Friday. If, in aggregate, these data really come in much below expectations, is there a risk, do you think, of a 50 basis point rate cut this month?
I think it's possible. I've said kind of along from our perspective, you got to look at the entire cycle of this Federal Reserve. And at the front end, they were very slow to act. They wanted to make sure that the data was really pointing towards inflation and really obviously probably waited too long to act and then took quite a bit of action to increase interest rates. It's hard to see how they're going to have different behavior at the back end of this cycle, because there's still just enough data to show that the economy is still somewhat okay. Like you said, the employment number is a big factor in that. But I think the bigger scare is really reigniting inflation. I think that's what the Fed's really focused on. They're going to let employment start to slip a bit before they act, because there still is room in the employment market. Yes, obviously, mid fours is higher than where we were, but I think the Fed's going to need to really see the fact that inflation has come quite a bit closer to their 2% target before they move beyond a 25 basis point cut. I do think if the chances of them not cutting are pretty much zero. I think that'd be a disaster if they didn't cut at all. A 50 basis point cut, what that would tell me is that the Fed sees more underlying data pointing to a harsher economic slowdown, to use a soft landing, hard landing term, that they're starting to see a hard landing scenario. But I'm just not seeing that right now, so It's hard for me to believe that the Fed's going to take that kind of action.
I want to get your reaction to what we had in the equity sell-off today, where tech led the decline, especially the chip makers. We were talking about Nvidia a moment ago. In the regular session, this stock was down 9.5%. Yeah, it's part of the AI story. We know of that. But does this come as a surprise to you, or is it logical given the tremendous run-up that we have seen in many of these names connected to artificial intelligence?
No, it doesn't give me that much of a surprise. I don't act like I saw this coming because I didn't see that, have that crystal ball. But, when you start to see that's the point. When you start to see valuations get stretched and a more narrative-based investing environment, what that does is it creates the opportunity for bigger sell-offs. So it's difficult. You don't want to time it, but that's why we've been moving more defensively, because we don't know if the equity markets are going to completely roll over. But when valuations get this stretched, and they're not by any means, bubble territory, but we can all see that valuations are on the high side. So that's the time to start playing a little bit more defense. That doesn't mean move to cash, but you're just kind of moving into higher quality, lower beta names, so that you avoid scenarios like today. And it's not a surprise that tech would lead a sell-off like this, because it's obviously led to the upside. And that's where the valuations are the most stretched. And so, and they're obviously, semiconductors are one of the most cyclical sectors within the S&P. So as we start to see a shift towards a potential faster slowdown that obviously will affect the sale. And we heard it in the earnings, previously a couple weeks ago from some of the big tech where they were saying that, hey, we're decelerating our spend on chips because demand is starting to slow overall, whether it's cloud, AI, or the like. So it's not a surprise that a small piece, what can seem like a small piece of news, can make very big moves in stocks because of that valuation piece.
So I hear what you're saying, higher quality, low beta names, but that's the equity space. Are you inclined, and I also hear when you say, we don't really want to park in cash or cash equivalent at the moment, but are there opportunities in the fixed income space that you like, the corporate bond market? Do things look attractive there?
They do. Corporate spreads are historically, on the tight side. But with that said, when you look at higher quality corporates, you could even look at treasuries or mortgage-backed securities. It's one of the most asymmetric risk to reward profiles I've seen in a long time, meaning that, the risk of interest rates going much higher from here is very, very low. And so your other two scenarios are the interest rates stay where they are, and I'm very happy to clip, 5 to 6% coupons while I wait, or on the upside scenarios, we see interest rates collapse because the economy is slowing down, and then you're going to see that price appreciation of those bonds. So yeah, within our asset allocation, going longer duration, fixed income is our highest conviction trade.
Wow.
Above what else we're doing in the equity side.
So I'm curious about the house view at Winthrop Capital, given the fact that September is historically a tough month for the stock market. Are you expecting more in the way of downside?
Yes, we are. And the way I'll say it is, what we're really seeing or what we are expecting is heightened volatility. There's a lot of things happening right now, right? There's a big election coming up.
Yeah.
It is obvious. And then on top of that, you've got the fact that what the Fed may or may not do has been what's driving markets for the past year, and that's just going to accelerate the further we get into 2024, and there's these expectations kind of come to a head, and whether the Fed cuts, whether the reason, and it comes down to the reason that they're cutting and how how dramatically they cut, because large cuts mean that the economy is really in tough shape. And so that in and of itself could lead to equity markets selling off just from that, trying to understand why the Fed is saying or doing what they're doing. So yeah, at the end of the day, heightened volatility is almost a guarantee at this point. And that comes with some bigger down moves. It could at the end of the day, ride through it and end the year up. That's probably the higher likelihood. But in the short term, yeah, we're going to see a lot of chop.
All right. We'll leave it there on the chop. Adam, good stuff. Thank you so much for being with us. Adam Coons, the co-CIO at Winthrop Capital Management, joining from Indianapolis. John Davi, founder, CEO, CIO at Astoria Portfolio Advisors, joining us from here in New York. John, thanks for joining us. A lot to take apart. Let's begin with that ISM PMI. Kind of a disappointment to many with continued weakness in the manufacturing economy. Are you concerned about what's been happening on the manufacturing side?
Well, it's been in contraction, as you said, for 5 straight months, but it was a small improvement from July. I think, the idea from our side of the story is that you've got to barbell your portfolio, because as much as, on one hand, you've got bad growth data like today. I mean, there has been some recent data, whether it's retail sales, non-manufacturing survey. We had upward revisions in GDP. We have better jobless claims. So there is some good data. So it's just mixed overall. Growth is slow, and that's why the Fed is going to cut rates.
It's a key week for a lot of data on the labor market. It'll culminate, I think, on Friday with the employment report. How are you reading the labor market these days? Have things been deteriorating to the point where maybe the Fed is going to consider something that is greater than 25 basis points in terms of a rate cut?
I think the odds right now are about 40% for a 50 bip rate cut. So I wouldn't say that that's high. I think the market in reality probably would get freaked out if they saw 50 bips, because that would imply that the growth is really significantly slowing. So I think the idea is, we want a series of 25 bip rate cuts while growth still remains good. And I think that will sustain multiples. It'll keep a lid on the market, and we won't have the kind of price action we saw today.
Yeah, well, some of that had to do with what we had in tech. The chips were hammered. I mean, Nvidia down 9.5% today, and then more weakness with the news of the subpoenas and this antitrust investigation. How are you viewing big cap tech now?
Well, I mean, our big call for the last year was kind of tilt away from big cap, mega cap growth. I mean, I would just say that, it's been a tremendous run the last 10 years for tech in general. 7 stocks dominated most of the returns. 7 stocks make up, north of 35% of the S&P 500 here in the U.S. I mean, that's obviously dangerous. It cuts both ways. So we've been suggesting people to kind of tilt away from that for quite some time. So we like equally weighted strategies. We like barbell in our portfolio where we still like owning tech. We just don't want like 7 stocks to make up most of those tech exposures. So on one hand, we use equally weighted strategies. And on the other hand, I do think it's time to kind of get things like, USMV, the MinVol ETF, XLV, the healthcare ETF, XLU, the utility staples. We like DGRW, which is a quality ETF that has a value tilt. The bottom line is we're saying barbell it, right? So most advisors that I oversee, I oversee close to $2 billion, thousands and thousands of accounts. Most of them are still long Qs, qual, SPY, and we're just saying tilt away, take a third of it and rotate into something that's more defensive.
How are you thinking about the 60-40 portfolio? I mean, a little bit of fixed income in there, or do you think that trade is already, or train, I should say, left the station?
Good question. I think, bonds have a place for sure. I mean, rate cuts, we are longer duration, so we're playing like that roll down, convexity move on rates. I think that, the bond market, if it were up to them, we'd get 200 bips of rate cuts. I think there's more down moves to go in yields, but I do think that you want to own, some alternatives. I mean, alternatives was a product that really couldn't be sold in an ETF wrapper. Most people just still looking at private credit, private equity, but an ETF wrapper, we've seen some, interest in like buffered ETFs, downside protection. I think that makes a lot of sense, kind of given where we are in the cycle, and the growth looks very, very, mixed and asymmetric in general from a risk standpoint.
Are you focused solely on what you're seeing here in the States, or are you tempted to look offshore at this point?
Well, I mean, the textbooks would say, Fed cuts rates, dollar weakens, emerging markets, would do better. It's been a tough call. We prefer India. We think that there's demographic issues. There's a good growth story. China is very, very challenging for most U.S.-based investors. Growth has slowed there. There's, just issues in general from like a macro policy standpoint. But, there's pockets of emerging markets that we think are attractive, and we would definitely start to nibble, especially if you get these rate cuts. Again, it's been 10 years of just dramatic U.S. outperformance. So in our global portfolios, we do have allocations to emerging markets and developed Europe, Japan as well. I would just say that that's contrarian because, most people here in the States, all they want to do is talk about U.S., and we are trying to inch our advisors to look abroad.
Well, one of the things that may be relevant here, if you believe that the DOJ is going to raise interest rates, and we see a flight of capital leaving places in the developed world, ex-Japan, and being repatriated back into the Japanese market, maybe we're looking at a little bit more downside. And I know that you know this well, that historically September can be a challenging month for stocks. Are we at risk right now in terms of Japanese players that they begin to repatriate and bring money home?
Yeah, I would say, we want to be overweight more the U.S. for some of the risks that you're outlining to begin with. I mean, usually when you go into the recession, U.S. usually kind of leads the way in and leads the way out. So we tend to be more overweight U.S. Once you get past those 7 stocks, the rest of the U.S. equity market isn't that expensive. And it's certainly, while EM is cheaper and DM is cheaper, it's not like it's egregious at this point. So we're a little bit of a vulnerable period for equity markets. The valuations are generally extended. So I think it's good to like own some of these alternatives, some of these buffer ETFs, downside protection. We've used BTAL, which is like a long short market neutral ETF. I think the idea is like September is, expected to be volatile, and it all starts with obviously Friday's non-farm payroll report.
Yeah, most definitely. Quick, in the time that we have left, which is about a minute, I want to get your take on the election. An economist over at Goldman Sachs published a note saying that if Trump were to win, that U.S. GDP could face a hit. Different story if Vice President Kamala Harris were to win, and then also have at her back Democrat control of both chambers in Congress. Maybe there's a positive outcome for GDP. How are you viewing the election?
Well, it's definitely, it's a lot more uncertain, obviously, with, Kamala being nominated. I think with Biden, the probability was, Trump victory for sure. So again, more of a reason for these asymmetric risks. I think longer term, we're of the opinion that, deficit will continue to grow. I think the gold market is kind of screaming and saying that, hey, we have a deficit problem. And, the fact that gold is outperforming equities year to date, and that's with gold entering into a period where it historically actually works the best, which is when you get this economic slowdown and you get rate cuts. So we would lean on gold to play a lot of the election uncertainty for sure.
All right, John, we'll leave it there. Thank you so much. John Davi from Astoria Portfolio Advisors joining us from here in New York City. McKinney is with us. He is a managing director, also a senior portfolio manager at NFJ Investment Group. He is in Dallas, Texas, and joining us here on Daybreak Asia. Thanks for dropping by. Can we start with the eco data, the PMI that we had from the ISM? This manufacturing activity picture does not look good at all, and I'm curious as to whether or not it changes your view on how to put money to work.
Well, we always, first of all, we always tell our clients to maybe don't, put too much weight on a single data point. Definitely today's data showed the manufacturing portion of the U.S. economy is still in contraction, and it was a little bit weaker than expected. And, that certainly led to, maybe, higher fears of a recession. But, we also have to take under consideration, for one, the unemployment rate, although it has been, creeping upward, it's still very low by historical standards, as well as the fact that the manufacturing portion is really the part of the economy that's been weakened by the high real interest rates for quite some time. And so once the Fed does start reducing rates, most likely as soon as this month, then that should in fact give a little bit of a tailwind to boost that manufacturing portion of this economy. So it's slowing, but we're not necessarily worried about a recession in the near term.
Does that make the jobs data that we're going to get at the end of the week all that more important?
Absolutely. I think that's definitely, we've been living in this world for the last 2 years where the most important catalyst or data point that we see month to month has been the inflation figures. And, really as of the last Fed meeting when Jay Powell basically suggested, okay, we're there on inflation. Now we're worried about the other side of the Fed's mandate, i.e. the jobs portion. As such, for the coming months, that'll probably be the biggest catalyst. You don't want it to be too hot and maybe turn the Fed off from cutting rates, but likewise, you don't want it to show that employment is in fact rapidly getting worse.
So, are you on balance kind of poised to be a little bit more defensive right now? Would you think that that's a part of your strategy?
We absolutely are, and it's really, I think, more than anything, just having to do with valuations. We're in a world for which you certainly have you have a slowing economy anyway. Now the Fed is poised to reduce rates, and that's normally a good thing for stocks. But this has been a long telegraphed rate cut, and to the point that not only is a 25 basis point cut in September priced in, but the markets are halfway there to pricing in a 50 bip cut. And so we don't really see a whole lot of ways in which the Fed's going to pleasantly surprise investors. And in fact, if anything, they could be negatively surprised. And the biggest portion is the fact that with the S&P 500 trading at around 22 times earnings, that's more expensive than it's been, 3/4 of the time over this millennium. And so the markets really aren't pricing in that much downside risk.
I'm sure you saw the meltdown that we had in technology today, particularly the chip makers. That may not have come as a surprise to you. I'm curious to get your take. What did you make of it?
Well, it's primarily a continuation of what we've seen since Nvidia's earnings. I mean, their earnings results were pretty solid, but they beat the consensus. They guided upward, but they didn't meet the whisper number, and that really just points out that with great expectations comes great responsibility. It's kind of you think about the opposite of value investing. The whole premise behind value investing is find companies for which low expectations are baked in. Versus right now, a lot of the mega cap tech is pricing in high expectations. And so you think, well, what makes the most sense? Yeah, I like to make the analogy. You have two kids. One of which is a straight A student that maybe comes home with an A minus, and you have the other kid that typically gets C minuses, and they come home with a B. Whose parents are going to be, pleased the upside surprise and buy them ice cream? Probably the other one. And so, that's really a lot of what's probably been driving our thesis and what the markets are seeing about this rotation away from what's been working so well the past year towards maybe what hasn't been. That means, small caps. It definitely means value stocks, some of the financial firms, as well as overseas stocks.
Well, talk to me a little bit about what you're seeing overseas. Are there areas or themes that you can unpack a little bit?
Looking overseas, I think the primary theme that we're looking at is just, again, low valuations. We're contrarian by nature, and so you want to find things for which the good news isn't already priced in yet. And if there's one sort of area that kind of piques our interest a little bit, it might just be the emerging markets. I mean, the story has been bad for a long time. They've lagged the broader markets for over a decade now, and as a result, relative valuations are since 10, 15 years ago. And so, there's some opportunities there. Obviously, investors have to be choosy. One way that we're recommending to our clients, if you want to play the emerging markets, maybe do it within companies there that pay dividends. It's kind of a unique subset whereby people don't think of stodgy dividend payers in emerging markets in the same sense, but what it really does is it means that you're focused on companies in the emerging market space that still have that growth dynamic, but maybe they're a little bit more mature in their life cycle. It means they're producing a lot of free cash flow and maybe a little bit more defensive way of getting that exposure.
Good conversation, Burns. Thank you so much for being with us. Burns McKinney, he is Managing Director, also Senior Portfolio Manager at MFJ Investment Group in Dallas, Texas. This has been the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg Podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.